need more money, you need a better plan. A better plan comes from better information, better decisions, which ultimately, in my opinion, comes from better advice. So I think there's not a person out there. I don't think there's a person watching this right now, whether it's now or 5 years from now, that wouldn't stand to gain something from better advice, whether it's better tax planning, reducing your tax liabilities, all that type of stuff, or whether it's better Social Security planning, better planning around areas like Medicare, IRMA, different income limits, different things like that. And it really, at the end of the day, all comes back to expertise, especially in a dynamic environment, which we're going to talk a lot about. We're going to talk about why to hire a guide at all. Okay, like why? What's the point? What's in it for you as an investor in terms of what's the advantage of hiring somebody? What's it worth to you? We're going to talk about red flags. So a lot of I'm just checking over on the video here on my iPad here to make sure it's coming through okay. But bear with me here 1 second. Why? What's the point? What's in it for you? I'm going to mute that now. So cool. So that's coming through all right. So we're going to talk about some red flags. Most of the issues that pop up with an advisor, you can detect well before they happen. Okay. So before you even meet with someone, before you even talk with someone, you can already run a lot of those background checks to make sure that the person you're dealing with, not only is qualified and competent and things like that, but that they have a good background of integrity, a good track record, good history, things like that. Knowledge and financial planning is obviously extremely important. In my opinion, though, soft skills can actually be more important than knowledge. And what I mean by that is, on March 26th, when everyone's wondering if there's going to be an American economy, after COVID and we're down 35%, having someone that actually cares about you, having someone that has interests aligned with yours, having someone that shares similar values when they're telling you, it's not time to sell, it's time to buy. It's time to do some Roth conversions. It's time to do some tax loss harvesting in a non-qualified account. Even though that knowledge base is very valuable, the more important thing is they have the soft skills for you to actually heed that advice and take action and actually do something, because knowledge is not power. It's only power once it's applied. So you need those soft skills to do that. We're also going to talk real quick about how there's no perfect advisor. There's only a perfect advisor for you. And that obviously looks different for each different situation. So we're going to start off by talking about why hire a guide. So a couple years ago, Vanguard put out a paper called Quantifying Vanguard's Advisor Alpha. And it's over on the left here. There's kind of a screenshot of it or whatever, but you can go Google Vanguard Advisor Alpha. It'll pull this up. And what I just wanted to share with everybody on this call right now is over on the right side here. Sound keeps trying to kick back on as I make sure it's coming through okay. Sorry about that. But over on the right side here, they actually put a value on each of these different things that an advisor does. So you'll see like asset allocation, it's worth something. They put a mark of greater than 0, which doesn't tell me a whole lot. Cost-effective implementation. What that means is the average client, the average investor that's using an advisor is paying an average of 34 basis points. So 1/3%. They're paying 1/3% less on expense ratios on their funds. Rebalancing, that's 1/4% value add from an advisor. Behavioral coaching, 150 basis points. That means 1.5%. So an advisor just on the behavioral coaching, just getting you to not panic and sell everything, just getting you to buy more when things are cheap, things like that. That's in Vanguard's, again, not opinion. This was a big study where they surveyed a bunch of people, tracked their account balances through time. The behavioral coaching aspect of this is worth 1.5% a year. Asset location, we have a couple different videos on that. We've done a couple presentations on it in this group and elsewhere. If you go check us out on YouTube and subscribe to that channel. Asset location means you should hold more of your aggressive assets in a Roth IRA and more of your conservative assets in like a traditional IRA, with the thought being you don't have to pay taxes on that Roth IRA, right? So you want those assets to grow as much as possible in an environment that's totally tax-free. So asset location is worth 0.75%. Order of withdrawal, they say, is worth 1.1%. And at the end of the day, they just go real conservative and they say an advisor is worth more than 3% in net returns per year. So $1 million an investor with $1 million portfolio, a good, competent advisor is worth about 30 grand a year to them. And now most advisors would charge you about 10 grand a year. They charge you about 1%. We obviously charge less than 0.5%. We use super low cost funds at Schwab as well. So like we're really cost competitive. And frankly, I believe this 3% number is really low. I believe the behavioral coaching is worth more like 2 or 3% a year. But that's more my opinion. I don't have as much data as Vanguard does, so we're going to go with their numbers. So it's valuable and it's important to hire a guide. Okay, there's some other reasons that Vanguard didn't look at. So like organization's a big one. I've told this story on here. I might have told it on the last video I did, but we heard a story of somebody that went into a long-term care facility. They were in that facility for a couple of years, and the family was paying for that long-term care facility. And come to find out later, after that client passed away, someone was going through their paperwork and they found out that that client had a long-term care policy. Okay, so the family was shelling out $7 grand a month or whatever for care that they had insurance that would have paid for. So just that organization aspect of it. Another one is if there is a death, if there is some unexpected event that happens, a lot of times pressure is going to cloud your decision making. So I talked about it on my estate toolbox video that we did in this group, but in general, an advisor is going to help you make better decisions when you're under the gun, so to speak, when you're really under pressure, where there's a lot of emotion attached to it. Whoa, what is going on? My computer is like shutting down here. Hopefully it okay, that was super weird. I don't know what happened. I wasn't even touching the mouse or anything. That was kind of freaky. But hopefully this is showing back up again. I'll keep my eye over on the video on the side here. But having the organization, having an advisor telling you what money's in what accounts, those types of things, super valuable. Future changes in the tax codes. We talk a lot about this. You don't want to spend your retirement worrying about some new change in the tax code, right? You pay us to worry for you. You pay us to keep up on the latest and greatest ideas and really enjoy your lifestyle in retirement rather than be glued to this stuff. Also, the idea of a backup quarterback. We kind of talked about it in the first bullet point here. I talked about it on my last video, but you want to have a backup quarterback. You don't want to have your survivor scrambling if something happens to you. And then another kind of final idea, this one's a little bit difficult to talk about, but it's a real thing, is the issue of cognitive decline. So I'm just making sure that the video comes back up for you guys. So good. So it's looking like it's back up now. The issue of cognitive decline, basically what I mean by that is over time, your decision-making ability, your verbal ability, your mental math ability, as you get older, it kind of slips, right? And my estate plan is structured in a way that if I don't take action by a certain age, then about 10 years later, I actually am not the one that's the main decision maker tasked with my investment portfolio. So there's actually another firm named for that. So it's Fiduciary Partners down in Appleton, as well as Eric, obviously being written into my documents, but to help with that stuff. But cognitive decline, nobody believes they're going crazy, and a good advisor can really help mitigate a lot of that stuff, especially as people are living longer. The medical science is getting so good that physically people are going to be doing well for much longer than they used to be. But the question now is mentally, are we going to be able to keep the medical science on the mental side of the game up to par with your body? So again, just another good reason to hire a guide. So some quick ideas on the red flag side of things. 87% of investors have never run a background check on their advisor, ever. The 13% that have done it, they typically just do Google. So they just kind of Google the person, they look at the website, that type of thing. I'm going to share a couple other good resources with you. So the first one's designation check. I'm not going to screen share and do it just because we're having video issues here, but designation check is a site you can go to. Well, I think we'll talk about it on the next couple of slides. We're going to talk about broker check. So that's through FINRA, the Financial Industry Regulatory Association. We'll talk about broker check. We're going to talk about the Wisconsin Circuit Court Access System, or CCAP, and then we're going to talk about what you can find just on asking for a statement. So Google and website. First thing I do if I was checking out an advisor is I'd look for bad reviews online. So is there a whole website dedicated to this company being a scam? And that sounds silly, but it's very common. And again, it doesn't mean they're a scam. It's just an accusation, right? But I'd rather know about it, and I'd rather know what the accusations are. So for example, there's some really big, well-known companies out there that if you type in the name of the company is a scam.com, it'll pull up and show you all the complaints, all the fraud accusations, all the different things, and you'll start to see patterns, right? So let's say the company has a pattern of recommending some really bad life insurance policy or something like that. You're just prepared for when you talk to that person that if right off the bat they don't know anything about you and they start recommending life insurance, you know something's up, right? It's a little bit fishy. So the other thing is pricing and fees. Are there pricing and fees on the website? Again, there are many good companies out there that don't show their fees on the website, but if one company shows their prices and another company doesn't, typically that company that's not showing their pricing, it's because it's quite a bit higher. Right. So the reason that we advertise ours so aggressively is we know that we represent a really compelling value for the investor. And then also social media. Not only do you want to see if they have an active following, if they have a big group and that type of thing, but do they have a lot of complaints? And again, they're just accusations. So if you see a bunch of complaints, that doesn't necessarily mean that that person is fraudulent or they're a criminal or whatever else. But it might mean that you want to keep your eyes open, especially if it's repeating. And you're hearing Harper, you're hearing the little over 2-week-old. She's up to like a little over 11 pounds now, so she's doing great. But you might hear her chirping in the background a little bit. She gets really mad about the advisor fraud. But anyway, so designation check. It's literally designationcheck.com, or you can just type designation check into Google. There are a lot of designations that are, I have the words plastic fantastic. They're just made up. So, it could be like I am a RFBA, and that is a registered financial badass, and it's just made up. Okay, so you want to go to Designation Check that looks through the American College for Financial Planning, and they make sure that the designation that person has is real. Because I can type 3 or 4 letters after my name on a business card, it doesn't mean anything. I can even type the word CFP, and unless I actually have the CFP, it doesn't really matter. It's just some letters on a business card, and you'd be surprised how often that comes up, that someone doesn't actually have the designations they claim they have. And then the other good one you can go to is FINRA broker check. So if you literally type in broker check, it's going to take you to a site. And if you type in the name of the company or the name of the advisor, it'll say, are they a registered representative? So if you look at my broker check, it'll say former registered representative. That means I'm now an investment advisor. So there's 2 circles. The top circle is RR, that's registered advisor, registered representative. And that basically means a broker. And then the bottom one is IA, and that means investment advisor. You care about the bottom one. You care about if it says IA, investment advisor, that means they're a fiduciary. The top one, you'd actually prefer them to not be a broker. You want them to be fiduciary only. So on Broker Check, you want to check that out. The other thing Broker Check's really awesome about is you'll see every official customer complaint ever registered against them. You'll see any fines, you'll see any regulatory actions. Some red flags are if you see a pattern of that. So you see a pattern of, hey, there's 17 variable annuity complaints on here, or this guy has 2 years experience, or he changes companies every 9 months. Those are the types of things that you kind of start to go, what's going on here? Why, what's going on? And you can do a lot of this research before you even meet with the person. So my favorite place to look is the Wisconsin Circuit Court. And the reason for that is there's a lot of things that you don't need to report that will say things about your character. Okay, so you want to know about bankruptcies. Now, again, a bankruptcy doesn't automatically disqualify somebody, but maybe they went bankrupt because they had a really big restaurant and COVID hit. And the government didn't let them operate. Okay, maybe that says nothing about them as an advisor, but it could also be that they were super levered up and they don't like to pay their bills, and they have a bunch of judgments and owe money all over the place, and it has nothing to do with a business. And they have spending issues and they run up giant credit card debt and stuff like that. So you just want to know, does this person have self-control? Does this person do what they say? Do they pay their bills? I've seen advisors that have assault or child abuse or drug issues, or literally felonies. Like you can be charged and convicted of felony fraud and still be a financial advisor, and that might be surprising. But this is a statistic from CNBC. So 2% of advisors have a criminal disclosure. I mean, they've actually done something criminal. And 13% of advisors have a customer complaint. 4% of advisors have a bankruptcy. 1% of advisors have been terminated. Those terminations, by the way, are a huge red flag. So if you've been terminated and it says for cause, so the word FOR and then a space and then CAUSE, for cause generally means there was something criminal there that the company didn't want to pursue because they didn't want to look bad. So generally what that'll mean is there was some kind of forgery or some kind of thing like that going on where the company just said, we're done here, you're fired, you're free to go, we're not going to charge you with anything. We want this quiet. We want everybody out of here. A lot of people have regulatory disclosures and different things like that, but 20% of advisors have either criminal, civil, or financial disclosures, meaning like they've had bankruptcies, they have judgments on them for debt, different things like that. Again, this isn't going to automatically disqualify an advisor. I've actually know an advisor that has a bankruptcy that it was pretty much what I laid out. He had a big restaurant operation going, and some stuff happened, and he had to deal with a bankruptcy. And he's a pretty decent advisor now. So you just want to know about it because information is power, and the more knowledge and information you have on this person. Charlie Munger, Warren Buffett's business partner, he says, if you show me the incentives, I can tell you the outcome. So it's same deal. If you know everything there is to know about a person, you know what their incentives are, you know how they're compensated, you know how much money they owe what people. Like let's say it's an advisor like me that only has a mortgage on his house, or it's another advisor that has a bunch of judgments and 15 different debts outstanding that he owes a bunch of money all over the place. Who's going to be incentivized to put a lot of pressure on you to do something so that he can get paid? This is all stuff you can find publicly. You can know all that ahead of time. And I really strongly recommend you do that. CCAP, the one quick thing I'll say about CCAP, make sure you have the right person. So there's like 7 or 8 Anthony Helen brands in Wisconsin, and 5 of them have a bunch of criminal issues. So you want to make sure you have that guy's date of birth, you have the right middle initial, you have the right county, all that type of stuff. Be really careful. And again, don't jump the gun. Don't instantly snap judge people, because sometimes it's the wrong person or whatever else. But let me, here we go. Okay. I just want to make sure because it looked like the video shut down there. So anyway, I hope it's still coming through on what everyone's watching. I'm going to just keep going. Couple of things you can do to test knowledge. The biggest one is these little questions that come up while you're talking with an advisor. And let's say you're talking about taxes or whatever, you can just throw a little question out like, what's the top of my tax bracket again? What's the top of the 22% tax bracket? And I don't necessarily expect them to get it instantly. Like maybe they got to pull it up on Google and then they go, oh, it's this. Married filing jointly, it's this. Or you go, let's say you're talking about Medicare, and there's a provision in Medicare called IRMA, which adjusts your Medicare premiums based on your income. And you might ask something like, when does IRMA come into play? And for me, I have that one memorized. So for 2021, if you made more than $176,000 in income and you're married filing jointly, and back in 2019, then you will have a higher Medicare premium than the standard Medicare premium. So you'll have that a couple $100 a month added on to your Medicare. And another question, am I subject to the tax torpedo? Those tax planning questions, just as a quick timeout. I don't expect them to instantly know that, but what I don't want to, if I'm meeting with an advisor, let's say I'm an investor, and I ask a tax question or I ask an IRMA question or whatever, and they say, they freeze up and go like, why does that matter? Or what's IRMA? Or why does the top of your tax bracket matter? What's a Roth conversion? Those types of things are red flags. And sorry, you're hearing Harper in there, but you wanna try to gather this information just to get a feel. You're not only looking at knowledge, but you're looking at their priorities. Are they tax focused? Are they fee focused? What's the outcome for them? Are they just looking to sell you a product, or do they really want to reduce your taxes over the long haul? Some of my other favorite questions are like, what's your client's largest holding? For us right now, that's tickers like this: SCHX, SPLG, SCHG, SC. If you look those up, they're at 0.03% fee, really good performance track record, really well diversified. And that'll tell you a lot about how that advisor thinks about things. You might ask them, what do you think about HSAs? I would not be surprised if an advisor, if you ask them that question, they go, what's an HSA? And that's a red flag. Like that's one of our favorite account types. And if they don't know what it is, you want to be aware of that. So a couple other things on the non-qualified side, you want to ask, do you recommend joint accounts or community property? We recommend community property. I have a couple quick tip videos in this group on community property accounts. You want to make sure that someone's not using like joint tenants, tenants in common, joint tenants with rights of survivorship, stuff like that. Those are inferior account types that will cost you and your heirs more taxes down the road. You might want to ask about tax loss harvesting. There's all these things. You don't even care about the answer, because you know the answer already. You know the top of your tax bracket, IRMA, don't ask a question that you don't already know the answer to. What you're trying to do is learn a little bit more about that person and what they believe about financial planning and investing. So that's just kind of on the trick question side of things, on the knowledge side of things. What I would say is more important long run is that advisor's temperament. So if you ask Warren Buffett, what's the key to wealth? He doesn't talk about saving a lot of money. He doesn't talk about earning a high rate of return. He doesn't talk about being an expert at timing things. He doesn't talk about, any of these different things. He says temperament. He said the most important thing and the hardest thing to have and the most valuable thing is a good temperament. So what I mean by that is, are they super rushed? I've been checking on my phone and my iPad here during this video just to make sure it's coming through okay. But if you've met with me in person, I hope that you didn't get the vibe that I had 50 different things going on and that I wasn't really focused on the meeting. I really care deeply about the client, and I really hope that comes through clearly. And that'll tell you a lot right there. I mean, if they're like, oh, I got to step out, hey, buy this, sell this, I got to do this. A lot of that is kind of for show. They're just trying to kind of big time you a little bit. But it also tells me where their head's at and if they're good at building a business. They should have a team in place where they don't have to do the second to second stuff. They don't have to answer the phone. They don't have to return a call. They have time to just sit down and meet with you for an hour and have a conversation about your goals. So that temperament thing is huge. Also, a little bit of a sexist thing, but it's statistically proven. Women are better judges of body language. So this is, you can go read a bunch of different studies on this. Women get better vibes. When I say better, I mean more accurate. Men are very likely to just be confident and think it's good, think things are good. And that's part of testosterone. That's part of what happens with us chemically. But what I recommend, and what I've done a lot over the years, is what people do is they'll have really good, really professional, honest body language for the first couple minutes of a meeting. And then after after you're kind of relaxed and calm and not really paying attention to that stuff as much anymore, they'll drift and they'll start to do some things that are, kind of red flag a little bit, where it's just like strange stuff. Not only will the female generally pick up on that stuff a little bit better, but also I like to have them come in 5 minutes late. And the reason for that is it's a lot of extra work to try to hide things twice and try to hide your intent twice. And, have them come in after the introduction. Hi, I'm Bob, blah, 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 blah. What are you looking for? What are your goals? All that type of stuff. Have them come in right after that, because it's like the advisor's guard is down now, and it keeps them off balance, and you're going to get more information. It just is the way it is. When I was out in Connecticut, when I was in Greenwich, we used to do this all the time. I would always walk into a meeting 5 or 10 minutes late if it was with another money manager. And it was literally just to try and keep them off their balance and unstable, and try and get us a little bit more information. Another great question is to ask them what kind of car they drive. That might sound silly, but I'll promise you the person driving the minivan or the sedan or the SUV or the pickup truck is taking less investment risk than the guy driving the Ferrari. Okay, and that there's actually, again, there's statistical studies on that. There's a study, I forget if it was Columbia. Somebody's got a study on that where they looked at cars people drive and investment risk. And the more expensive the car, the worse the risk-adjusted performance of the portfolio, which is pretty interesting. So Steve Mandel out in Greenwich, I had lunch with him one time. This was probably 2010, 2011. And I asked him what he drove. And it was like a 1992 Toyota pickup truck. And I was surprised. I was like, really? I mean, this guy manages $9 billion. It's probably 20 now, but at the time, this was a super wealthy, super successful guy. And I asked him why. And he said, yeah, I had a Bentley for a while and they kept getting stolen. And it was so annoying that I just decided to go with some old beater so no one takes it. And it's interesting, right? That tells you a lot about that guy. He's interested in time. He's interested in convenience. He's interested in simplicity and practicality. And he's not really interested in flash and like, $1 million vehicles and stuff like that. It tells you a lot about the advisor. My favorite thing to do is to reject fact. So what I mean by that is someone will say something along the lines of like, this is our approach to investing. This is what we believe. You should buy undervalued assets and hold them for the long haul and stuff like that. And I might say something like, really? Because I don't know if we're going to be a great fit. So this is me as a client. I don't know if we're going to be a great fit because I think the best way to make money is to trade futures. And what you're trying to do, even though I don't believe that, the reason that I say that I do that is because what I want to see what the advisor does. Do they get really angry? Do they start calling you an idiot? Do they go, oh, you're a moron, get out of my office, whatever. What you really are looking for in an advisor is they can laugh. I mean, I'd probably laugh if someone was like, I think the key to wealth is playing the lottery. I would laugh. Okay. But then I would go, time out. Do you really believe that? And I'd really try to get to the bottom of it. And I'd really try to do some behavioral coaching. And at some point they'd probably go, no, I was just messing with you. I just wanted to see what you do. But that's a really good tactic. Because again, if they instantly trigger and explode on you or say, I got better things to do. I make $1,000 an hour, blah, 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 whatever. That person just doesn't have great temperament. That's not a great advisor for you for the long haul, in my opinion. Another thing, spend as much time asking and evaluating that advisor's values as you do evaluating their knowledge. Ask them what they believe about the world. Do they believe in capitalism? Do they believe in America? Do they believe in free markets? Do they believe in businesses and entrepreneurship? What do they believe personally? You can go as wide open as what are their ethical beliefs? What are their moral beliefs? What are their philosophical beliefs? And you can have these great conversations with people, and you'll be surprised how clear some people's philosophies are, and B, how muddled other people's philosophies are. And you'll find sometimes the advisor's philosophy is I need to make 10 grand this month to cover my bills. And that's their philosophy. So you want to know about that. You're looking for a clear, concise, well thought out, is it a thoughtful person? That's who you want advising you long run. You don't want some, flash, super fast moving, here today, gone tomorrow type of advisor. You want someone that's methodical, well thought out, well researched, someone backed by a lot of data. So like if you start getting in a rejection of fact kind of pissing match, for lack of a better term, do they try to educate you? Do they try to show you more information? Do they try to get you in touch with better resources, or do they just kind of reject you and leave you to the wolves, so to speak? So those are some good temperament questions. My favorite thing to do in terms of last things. So let's say someone gets through all these steps. They have a background check good. They don't owe a bunch of money. They don't have a criminal background, all that type of stuff. Is before I'll invest, I'll ask to see a statement. So I'll just say, hey, would you mind sharing a client statement? You can black out the name and black out the account numbers and stuff like that. But can I see a statement? And what you don't want to see on that statement, you don't want to see levered funds. Okay, so what a levered fund can make you more money than the market when it's going up. It can also lose you more money than the market when it's going down. So if you have a 2x levered fund and the market goes down 10%, you go down 20%. So you don't want a levered fund. You don't want an inverse fund. You don't want options. You don't want to see high fee mutual funds. So you don't want to see like an American fund, for example. You're gonna be paying anywhere from like 0.5% to 1% just for the mutual fund, and then an advisory fee on top of that, where you can get better performance out of an ETF at a fraction, 0.03% instead of 0.5%. You don't want to see A share mutual funds. You don't want to see C share mutual funds. You don't want to see any mutual funds in a brokerage account. So not what I mean by that is if you have a non-qualified account, individual brokerage, joint brokerage, community property, those types of things, not IRAs. Mutual funds in there are very, very tax inefficient. It's really expensive for the individual investor to have mutual funds inside of a non-qualified account. And then variable annuities. I'm going to wrap up. I know I'm going a little long, but this is a really fun story at the end. So this is a statement for anyone that was an investor with Bernie Madoff. So this statement, you can see in the upper right here, it's from September 30th, 2008. And there's 4 red flags on the first page. Okay, so the first one here is there are a couple trade dates over in this left column. They were placing trades on holidays. They were placing trades on weekends. They had trades settling on days the market wasn't open. There's a lot of stuff with the dates going on that didn't make any sense. So if I just saw that, I'd be done. I would not put money with that firm. Also in the middle here where it says Fidelity Spartan, that money market fund did not exist in September of 2008. So I'd be curious, that one I'd ask about. I wouldn't reject out of hand. I'd go, hey, why do you show Fidelity Spartan, even though that fund was closed up a couple of years ago? It was closed up back in like 2005. Why are you showing the Fidelity Spartan money market fund? Also, you have a dividend here from McDonald's. They didn't pay a dividend that month. What's going on? Where's this income coming from? So you can see some of those types of things. But the most important thing in the upper left here, the single most important question with all this stuff is, who is the custodian? Who is actually holding the money? Who am I going to get my statements from? If I need to take money out of the account, who am I going to be getting a check from? So with us, it's Charles Schwab. With other good advisors, it can be Charles Schwab, it can be Fidelity, it can be TD Ameritrade, Trust Company of America, Pershing, Bank of New York. There's a bunch of different great custodians out there. But what you don't want is to have the statement coming from the company that's managing the money. Because guess what happens? Their incentive there is not to tell you the truth. Their incentive is to have the results look as good as possible. So they're tempted to kind of pad the numbers on that statement, make things look a little bit better than they are. And they can do that. They can also move the funds around. They can dip into the funds, take money out, do different things like that. You want to make sure there's an independent custodian. It's the single most important piece. So again, if you invest with us, the money is not, the securities are not held in my office. Okay, they're held by Charles Schwab. And they're an independent custodian, and their only job is to show you objectively the value of your accounts, the value of your investments, objectively show you your performance. I really recommend a statement review. That's something that people actually pay us to do. High net worth investors pay me to do statement reviews and just let them know how things look, even though they might not even be interested in moving. They just want to know it's legit. And they know my background on the analysis side of things. We can get a lot of information out of a statement. So, a couple things to look for there. Do the funds exist? Are the dividends real? Are they happening on those dates? Are the trades happening on the right dates? Different things like that. Just does it pass the smell test? So in summary, hire a guide. Okay, I have in my documents, if something happens to me, Eric is my wife and children's financial planner. If something happens to him, then the firm name is Fiduciary Partners, and they're down in Appleton. They're a fiduciary, and they go out and select advisors for trusts and estates and different things like that. I really recommend you do your own research. Most advisors, over 50% of advisors, can be disqualified before you even meet. When you go into broker check, there'll also be a link to SEC advisor info. That's another one you can actually type in. It's advisorinfo.sec.gov. You can type in an advisor. You can even see their fees through their ADV brochures. We didn't even get into a bunch of that stuff, but you can see advisors' fees before you even meet with them. You can see, again, criminal backgrounds, different things like that through CCAP and those types of things. Knowledge is extremely important. You want an advisor that is very tax focused. So if they don't know anything about taxes, they're not going to be able to help you with your largest expense in retirement. Ask a bunch of tax questions. Soft skills, temperament, how they view the world, what their philosophy is, how long-term their perspective is, how they handle challenges, how they handle setbacks. Can they if you guys watched the Packer game here over the weekend, Aaron Rodgers had a throw where he was standing in his own end zone and he held the ball for like 4 or 5 seconds as the world was falling down around him in his own end zone. And he threw like a 20 or 30 yard pass. You want someone with poise. You want somebody that in a chaotic crisis situation can actually help you out of it and help you capitalize on it, ideally. And in closing, I just want to remind you all that there's no perfect advisor. There's only a perfect advisor for you. The right advisor for me, the right advisor for Eric. We're the right advisor for our clients. We might not be the right advisor for other clients. It's a very personal thing. You got to find someone whose values and goals match up with yours. And I just want to remind everybody, I'm going to go back up to the top. I thought I had this back in there, but you don't need more money. You need a better plan. Plan planning comes from better decisions, better information, and ultimately a better advisor. Thank you guys all so much for watching, and thanks for being in this retirement mastery group. It's been a lot of fun. I'm gonna go help the wife real quick with the baby that you've heard in the background. But thanks so much for joining us for Wealth Wednesday.